Okay, welcome everybody. How are we doing this afternoon? Hey, you see what I'm wearing? You see what I'm wearing? Now, you've known in previous meetings I've tended to give a few jabs at the Vikings because they can't seem to win the big one. So now that they're doing well, I have to give them credit. By the way, I was a little bit late because Coach Zimmer needed a little advice this afternoon. So, you know, Lyndon asked if we were getting anything out of wearing this at the meetings, and I said, well, I applied for Super Bowl tickets, but I don't know if we're going to get them or not. So I guess we have to get there first, right? Anyway, welcome everybody. You want to maybe leave that shade down a little bit. That's pretty bright coming in this afternoon. That reflection off of the sun is kind of nice to see. But appreciate you taking a little bit of time out of your afternoon today to go through the information with us. We have a lot of information I think that's very timely, and we'll talk about what's going on in the bean market. Pretty easy answer, but it's something that we don't expect on the 5th of December to be talking about a weather market. But that's what we have going on right now. We're kind of actually starting to wind down a little bit on our meeting schedule for this time around. This, I think, is number 6. So we have, must be 7 already. So we only have 3 to go now. Garrettson tomorrow morning at about 9 o'clock at the Legion there. And then 9 o'clock at Jackson for the Alpha customers. That's one of the new Cargill acquisitions. So if you know someone that wasn't able to come today or whatever, the next closest one would be Jackson. And then we finish up Thursday afternoon way over at Marna. That's a little bit east of Blue Earth. So we kind of bring those people in and get them used to what New Vision's all about. As we go through today, we're going to go through an agenda very similar to what we've done at previous meetings. Now we have to really, to kind of get a baseline of where things are at, go back to the last USDA production report, which was on November 9th. Now we have a supply and demand report coming up from the USDA next Tuesday on December 12th, but they will not update the production numbers on that report. That'll just be supply and demand only. So we'll also go back to the November 9th supply and demand report tables, take a look at what they told us in November, and give you some ideas of what to watch in next week's report and what direction we're going as far as the demand so far. We're going to spend a fair amount of time discussing what I want to term as a global snapshot. For a long time, we've talked about the fact that we are now in a global marketplace with our grains, and that's more and more evident every day. In fact, right now, the only reason soybeans are up 10, 12 cents today, nothing to do with what's going on in the U.S. Right now, it's all about Argentina. It's all about the weather market. It's all about the potential La Nina that we have going on. And that really started, I think, it's been in the back of people's minds for quite a while, but it kind of came to a forefront a little bit more Sunday afternoon, Sunday evening, when the extended forecast came out for Argentina in the next 10 days showed hot and dry. World Weather put out an update Sunday afternoon basically saying that high pressure ridge moving into Argentina, possible crop damage because of that. We gapped higher Sunday night, strong yesterday, strong today, because the forecast continues to be hot and dry for Argentina. We'll talk about U.S., we'll talk about China, the demand piece there, how the production in the world has changed, and how the U.S. fits into that piece. We'll also talk a little bit about weather, show you what a La Nina actually is, show you what to watch for, and show you on the weather maps, both in South America and the U.S., what it might mean to our weather if, in fact, we go into that phenomenon during the winter and spring months here. We'll look at corn and soybean price outlooks. We'll talk about some grain marketing possibilities. Now, initially, we'll just talk about cash prices, about basis, how we get to that point, what we see going on in there. And then at the end of the meeting, Jim will be talking about some what I like to call hybrid contracts. This is a lot different than probably what you've ever seen or even thought of before. In fact, if you're a more traditional marketer, it'll make your head spin. But that's why we have full-time people at New Vision to help step you through those things. When prices are low like this, to use a small percentage of this type of contract in your marketing plan and your toolbox, it can help enhance your prices and make for your better operation. And then finally, questions are welcome anytime, questions and your comments. And you notice that is Vikings purple. Had my blood checked about a week ago. The nurse went and got the doctor. She said, something's wrong. This guy's bleeding purple. I said, no, I'm just a Vikings fan. But I'm a realistic Vikings fan. See, I'm not getting my hopes up yet because there's still 4 games to go before the playoffs, right? So as we go back to November 9th, the crop production, that was a day that really pretty negative on the corn side of things. We'll look at a minute here where they increased yield nationwide 3.6 bushel per acre, and that was not expected by the trade going into that report. In fact, I think the trade really thought there'd be a possibility of the yield in November going down from the October estimate because they didn't really believe the October estimate, and the reports weren't coming in all that favorable. You had some good, you had some bad, and later on it all kind of changed. But, so we had an increase on the yield per acre, and when we look at a historical perspective chart of corn production in the U.S., we see this crop number that they gave us in November, 14.6 billion bushel crop, second largest corn crop we've ever raised in this country. And that was on top of a carryout that was pretty adequate already last year. So not real friendly news on the corn side. When we look at a yield map, now this is a USDA map and shows the changes from October to November. The states in blue had yield increases from October to November. The states in red had decreases. The states in this gray color were unchanged. Nationwide, we are up 3.6 bushel per acre to 175.4, second highest yield we've ever had. You can see, for instance, down home here in Minnesota, the corn crop rated 6 bushel higher at 190 for a state average. That's down about 3 bushel from last year's all-time record, but a very good crop. And I think when you look across most of the Corn Belt states and see all of these blue colors where the yields went up, this was a common thing that we heard as harvest progressed, 50, 60, 70% done. Almost everybody in every state, except maybe Nebraska, reported that yields were better than expected. Now, how did they come up with this big yield increase? When we look at the USDA's methodology on how they get to corn yields, they look at the pounds per ear, or basically your test weight, and the ears per acre, which is your population. We see here from October this year to November, what happened is the number of ears, the population was basically unchanged. But what they found in the November report when they went to do their surveys is that the ear weights were much heavier. In fact, you can see how this rates to past years. It's one of the heavier corn ear weights that we've had. And once again, I think that probably goes to the weather we had late season, the August and September rains, the fact that the frost never came early, and the corn crop was pretty much allowed to mature as it wanted to, and the genetics that are bred into our plants right now really performed well. Okay, part of the reason you come to these meetings is to find out not necessarily what's happened, because you can get that anywhere, but what might be coming down the road, right? You want the crystal ball out. Well, this gives you an idea from a historical perspective on what the USDA corn yield changes tend to be from November to January. Remember now, there will not be a production update in December's report, so we wait from November to January to see what the yields are going to do. And here is the zero line, so if the November and January yields were basically the same, you'd be right on this zero line. What we see here is for the last 4 consecutive years, what have we found when we got to the January yield estimate on corn? Lower than November. Anywhere from 0.7 of a bushel down to 2.4. So, if you're somebody that really wants to be real bearish corn, this might caution you just a little bit, because there's a tendency that we may find that yield drops a little bit in that January report. But from today, we've got another 5 weeks to wait. And we know that the markets, they don't like to wait. They kind of like human nature. They want things now. So this is something to keep in mind down the road. We'll have to see what happens on that January 12th report. INTL FC Stone put this yield matrix together that kind of helps explain, I think, where we are, where we might be headed, and what has kind of helped to get us into the situation where we literally have too much corn. We go back to when we started raising corn, and for many, many years, the 1800s up to about 1936, yields just didn't change. And then we started seeing research and new genetics start to come into play. From 37 to 54, corn yields went up on the average about 0.7 of a bushel per year. And then from 55 to 93, a lot of advances. A lot of dollars put into raising more corn to feed the world, that the population was growing, that was going to need more food and need more meat and feed grains to feed the livestock. about 1.89 bushel per acre each and every year on the average. Now we have our weather drops and everything in between, but on the average it averaged about 1.8. And we thought we had kind of reached a plateau there, and then pretty soon we started getting into the GMO, the triple stacks, the new hybrids that we have today, and we continued that 1.86 bushel per year increase in trend really from 1994 right on through today. And now we sit here today, the last 2 consecutive years, above 175. That used to be a record crop on a lot of farms, right? I can remember growing up, 120 bushel corn was a big crop. And now we're disappointed if it's not 220, right? So things have changed. We're not farming all that many more acres, but the technology has really come into play. A couple things that we should take out of this information, I think. First of all, with this type of reliability on yields, are the chances very great that we're going to have a year where we really have a disaster and have nothing to sell? So maybe we need to get to change our way of thinking and get to be a little more aggressive at marketing when we get that opportunity, because that opportunity usually comes before the crop is what? Before it's made. And if you market like my father used to, you didn't sell it until you had it where? In the bin. And that's the way a lot of us think, but times have changed. And now with the genetics that we have, the other thing we have to keep in mind, 2 years ago, we didn't have perfect weather nationwide, and we raised a record crop. This past year, the weather was even more marginal. I mean, look at Indiana and Ohio, some of those states that were extremely wet, couldn't get their corn planted. And they went to harvest their corn, and it wasn't that much different than a year ago. So all of a sudden, the markets might start getting a little bit numb to weather scares on corn, because it seems like science has kind of taken a lot of the weather risk out of the market. Not that we won't have them, but it's probably a situation where we're going to have to see damage rather than just hype out of a 6 to 10 day forecast. Okay, coming down to the supply and demand table for corn then. This is last year's table. We just kind of use that as a reference point. Here's this year's table, the October numbers, and then November. With that 3.6 bushel per acre increase up to 175.4, it basically gave us almost another 300 million bushel of corn to deal with this year. And this is one of the reasons why you had low prices this fall so far and a relatively wide basis levels on corn relative to historical numbers. Because if you take this crop that we raised of 14.6 billion, add it to last year's ending stocks of 2.2, you see there was just under 17 billion bushel of corn available to the marketplace this fall. So with that type of supply, most of the buyers and the market thought things were going to be kind of an easy buy. We have to also keep in mind, though, the total demand for corn now at 14.4 billion bushel. So if you divide that by 12, the market uses well over 1 billion bushel of corn every month and needs to be able to source that corn. So as we get into talking about basis later, we have to remind ourselves that if the price is low and the farmer's not selling, the basis and spreads might have to do a little work. And that's possibly where we're at today. Now a few things to watch as we get ready for next week's report on Tuesday the 12th. Really 3 areas on corn you want to focus on, because they will not be changing the production number in this report. So we want to look at feed residual, and last year 5.463, this year 5.575. That was raised 75 million bushel from October to November, and that is probably a very legit number. Probably won't change in the December report. If there's a change, it will come in January, because on January 12th they'll also have the quarterly grain stocks as of December 1st. And that's when they tend to make changes in feeding. But for right now, this number looks pretty sound. It's higher than a year ago, but if we look at our recent livestock reports, last cattle on feed report up 6% from a year ago, hog report up 2%, most poultry species are running up 2 to 3%. So we have more mouths to feed, and the corn demand for feeding should be good. Next area is on ethanol. Last year 5.39, this year projected at 5.475. So far this year, we're on pace to meet that number or possibly exceed it by a little bit. Now, the thing that may hold back ethanol from growing a lot as far as the corn demand area is the fact that our ethanol stocks are also very large. And if we want to keep this industry running or grow it even farther, we're going to have to start exporting ethanol, because we're basically producing more than enough to meet the renewable fuel standard and to meet the demand in the United States right now. Yes, sir?
And where is the allowance for the DDGs that are fed? Is that added back to food, feed, industrial use, or feed residual, or is it just not considered at all?
It disappears.
They don't even count that?
No. You know, and that's a good point. And that question has come up at almost all of our meetings. You know, when this corn that goes into ethanol is made, the DDGs are just kind of there. Originally, when the ethanol industry started, DDGs were viewed as what? Leftovers, a byproduct. Kind of worthless, right? Kind of like soy hulls, something you just had to get rid of. They were more inconvenient. That's changed, because as we get farther into this presentation, you're going to hear me talk a lot about that this market now is driven by protein. And that's why the soybean market is acting the way it is today. You see, if we look at feed grains like corn and wheat, they convert into starches. And right now the world has way too much starch and doesn't know what to do with it. But on protein, you need protein to make meat, you need meat to feed these expanding populations. So the focus is really on protein. Why am I talking about that with DDGs? Well, let's look at that. Originally, DDGs were thought as a byproduct and basically garbage. But the protein from corn, just whole corn, is what, 7 to 8%? You've got your soybean meal at 47 to 48%. What's the protein of DDGs? Can't lose sight of that. Anybody know? Mid to upper 20s. Through that process of making ethanol, the protein actually goes up substantially. So all of a sudden now, if you're somebody that needs protein in the world, on part of that demand, you can displace soybean meal or canola meal or cottonseed meal with DDGs. And that's actually going on right now. Part of the reason right now why DDGs are very overvalued. Right now in our feed going out this week, I think our DDG price is $139 a ton. Whole corn is $110. It's not supposed to be that way for a byproduct, is it? DDGs should be 75, 80% of the value of corn, and they're $30 to $40 over corn. But the problem, the reason that's happening is because today you've got soybean meal at $3.16. So you have DDGs having to go somewhere in between, looked at more as an alternative protein. Does that answer your question?
Kind of, but in other words, those tons are never really accounted for,
No.
even in the reduced soybean meal usage or anything.
Not really. You know, and that's a challenge for the USDA, because everybody knows we're feeding DDGs. And realistically, some of those DDGs are displacing either soybean meal or corn, but they're not accounted for. And that's why, you know, we can pick at the USDA and say, well, how come they can't be right on these numbers, right? Well, that's one of the areas that's tough, because they all know somehow it's going to creep back into this feeding number, but you just don't know how much and when. And that's why these quarterly grain stocks reports are important. We measure the corn that's in the bin. And then we know what's been exported, because that's reported weekly. We know what's been made into ethanol, that's reported weekly. So we back into this feeding number based on what's left for actual inventory. That's why these quarterly grain stocks are very important, and the next one comes on January 12th.
Do you foresee that they might add that category someday to these,
I don't think so.
even as big as ethanol is?
This is, well, but you know, ethanol's been around now for quite a while. And they just kind of adapt with it. I think the response would be, we do update it every quarter. How much more do you want it? You know, and rightfully so. You know, and on this DDG thing, one last point that I think kind of goes along with what you're asking. Big part of my job is to source DDGs for the meal every week, for the mills every week. And because of that, because we have to have product to make DDGs, and sometimes the plant may go down, or they may not have the supply, or they might be too expensive, most weeks we'll be buying from 5 to 8 different plants to spread our risk around a little bit. And I was getting real frustrated with one very predominant ethanol company in this area. I won't say what the name is, but they have plants in Bingham Lake, Ashton, Chancellor, Hudson. Figure it out, okay? And it was going week on week, where I would have DDGs contracted, And at 7 o'clock on Monday morning, I'd get a call saying, Dan, I just wanted to let you know we're not going to have product at this plant today because they had a problem over the weekend. The chemistry didn't work and we didn't have DDGs. And I say, wait a minute, do I have a contract? Well, we'll call you when we have product. I was getting pretty upset because it happened like 3 weeks in a row. And I drilled, kind of worked my way up the ladder and got to what I thought was going to be somebody who could give me an answer. And I said, how do you expect us to run a business that way? You couldn't run your business that way. And I was told, point blank, I've taken your concerns to the top of the company and I've been told, we are an ethanol company. We don't care about DDGs. True story. We make ethanol. DDGs. So you see the mindset, even in that industry, is still that once it's made into ethanol, it kind of disappears. Last category to watch next week, exports. Now, so we're pretty good. We think the feeding numbers sound. We think the ethanol numbers sound. Export number, look at this. Last year, 2.29 billion of corn exported. This year, it was 1850. They raised it up 75 million bushel to 1925 in the November report. And there's not a person on God's green earth right now that believes this revised number. Because we're about through the first 13 weeks of this crop year that started on September 1st, and every week we're coming up short of where we need to be to even meet this lower number. We're way behind. There's a very good chance that the corn export number could be lowered as early as the December report and probably should be lowered then. Might wait until January. And knowing the USDA, they may wait and see what happens down the road. Why did they increase it if we were running behind the pace? Because it was an offset to this huge increase in production. Had they not done that, this carryout would have went over 2.5 billion in this report, and it possibly could have taken another 10 to 15 cents off the corn market, which would have made you real happy, right? And it doesn't make Washington happy because they want cheap food, but they also want the farmers to be around to raise it again next year. So we'll see once what happens. That's an area of concern right now, is on the export side. Coming down to the bottom line, ending stocks at about 2.4 billion bushel. I always like to compare this to the previous year. In ending stocks on corn, what's left over on August 31st of next year is actually still doing what? It's growing. And as ending stocks get bigger from a historical perspective, what tends to happen to price? Unfortunately, it leaks a little bit lower. And we kind of see this. Last year's average price, USDA said averaged $3.36 per bushel for cash corn across the United States. This year in the November report, they gave us a range of $2.80 to $3.60, and we'll get that range every month, and it will change as we get farther into the year, but the average is $3.20. So the USDA is basically saying expect corn to be about 15, 16 cents a bushel cheaper than what it was a year ago. Now, if I'm a farmer looking at my marketing plan, this average price of $3.20 is where I want to start watching closely. I want that to be the target that I try real hard to beat. Because most years that average price will be fairly accurate. In fact, if you look at history for the last 10, 20 years, USDA actual price versus their projected price is usually within about a nickel or less. So you can kind of rely on that a little bit. So keep that $3.20 price in mind. Now, another thing that I think that we need to be aware of and remind ourselves of is how the demand for corn has changed just within this country. We go back to the year 2000, and 60% of the corn that we used was fed. 20% was exported, 20% was in this food, seed, and industrial. A lot of people call it FIS. This was before what? Ethanol. Before ethanol. Now we come to today's world, 49% is now on this food, seed, and industrial, mostly ethanol, 38% in feeding. Even though we're making more meat, we have more things, we've become much more efficient, and we're just doing a better job. Some of that's probably DDGs. But look at exports, down to 13%. And you see, the thing that we need to remind ourselves and learn from this is when we have too much corn in this country in the past, what did we do with it? We exported it. But that piece of the pie has gotten a lot smaller because things have changed in the rest of the world. As much as we had fun and made tons of money, when we went to $5, $6, $7, $8 corn, the rest of the world did what? They tried to raise corn. And you know what most of them found out? They could do it. And now they're raising corn in the Ukraine and more in Argentina and more in Brazil, but they don't have an infrastructure to really use all of it, so the extra that they raise gets what? Exported into the world at whatever price it takes, basically to take business away from the U.S.
We are exporting a lot more corn than that shows because it's done in meat rather than...
Absolutely, absolutely, 100% right. Yep, exactly that. I don't know how I got this thing to back up. That's never worked before. It just did it. Okay, now on the soybean side. This also was, at first people looked at this and thought the B number maybe was a little bit friendly because they didn't change the yield. But then when you look at the total production of soybeans in this November report, at 4.43 billion bushel, it's what? How does that compare to the previous years? It's a record. It's more soybeans than we've ever raised in the U.S. before. Now, the yield didn't change, but we have to remind ourselves that this year, the American farmer planted over 6 million more bean acres than a year ago. As far as yield changes, Minnesota was left unchanged at 46. That's down substantially from last year. Last year, our state yield was well over 50, and that was common from what we heard from our producers. Most soybean yields were down 3 to 5 bushel from a year ago. And if you were lucky and had beans unchanged or maybe even a little bit higher than a year ago, you're in the exception. Nationwide, yield was left unchanged at 49.5. Now, likewise on corn, unlike corn, or I should say this is how they come up with the bean yield, grams per pod, or the pod weight, and the number of pods in an 18-foot square. How did it change? Well, you see they had October, the pod weight quite a bit higher. The pod weight came down, but they found more pods in that 18-foot square. Probably once again a function of the weather we had late season. We had good August rains and there was some new pod sets, but for some reason they just didn't fill or get the weight that they thought they were going to in October, and that's why the combination of the two, yield was left unchanged. Now here's the chart that shows the USDA yield changes on soybeans from November to January. This would be if those two yields were the same on the zero line. And once again, we find that the last 2 consecutive years, that soybean yield has actually went down a little bit when we came to the January report. And I think that's something that's in the back of people's minds with soybeans. What if that happens? Then maybe this carryout on beans comes down a little bit. We put a little bit more risk premium into the market. But really, if you look at the 3 years previous to that, they went up about 0.3 of a bushel each year. So I think what this is kind of telling us is we shouldn't expect a lot of drama on that final soybean yield. It could be a couple tenths lower, it could be a couple tenths higher, so maybe the range is 49.3 to 49.7. Probably not a big market mover. Surprise would be here is if we see the USDA for some reason come in and raise that soybean yield back up above 50. I don't think it's going to come down a long ways, but some still think that 49.5 might be a little low. When we look at how the soybean yield has changed, to give fair time to what we did on the corn side, way back to when we started raising soybeans in this country, we've averaged an increase of about 0.3 of a bushel each year. This is how they figure their trend line yields. But look at what's happened here on soybeans the last 5 years. You see, for years and years, if you remember that corn yield chart, almost all of the research dollars by seed companies were going into what? Developing corn and feed grains. And soybeans, kind of like DDGs, were just a rotation crop that nobody really cared about. But see, that's changed now with this demand for protein. So now all of a sudden the world's very concerned about that. So dollars started coming into the soybean research, and look at what's happened here. Kind of like when we started talking about GMO and triple stack corn, right? Yields exploded. So maybe we're coming into a time frame where 50 bushel plus national average soybean yields are common. Now the other thing we have to keep in mind about some of these genetics is when we have all of these new genetics in corn and new genetics in beans and getting better yields, we keep that within the borders of the U.S., right? No, unfortunately, the world has access to that too. And yields in Brazil right now are basically on par with what we're seeing for yields in the United States. And they're looking at improved genetics also to further enhance their yields and expand their production. Here's our balance table on soybeans. Last year's table, this year's table, October to November. Really not much in the way of changes from October to November. You know, the yields were left unchanged, so production, just a little bit of a counting thing there, but really not any change. Two areas to watch on the soybean side. The one is crushing. Beans that are made into meal and oil. Last year at 1.89, this year projected at 1.94. So far, the first couple of months, we're on pace to meet that crush projection, but it's probably not able to go much higher. If you survey the industry, they're going to tell you that this is pretty much at capacity. And right now, the soybean industry is crushing hard. They're pushing their crush each and every month. And to some degree, I think it's just in case this thing doesn't get settled with Argentina as far as biodiesel imports. And if the ruling goes where we're going to stop those imports, the market thinks we're going to have to crush more soybeans to get the soy oil to make soy diesel. The challenge with that, and we see that in the marketplace today, is when you take a 60-pound bean and get 11 to 12 pounds of oil and a pound of hulls, what do you make more of? Soybean meal, right? You get about 47 pounds, 46, 47 pounds of meal out of that bushel. And if you're crushing for oil, you accumulate meal quickly. And that's why, from a livestock perspective today, soybean meal basis is at levels I haven't seen it in 5 to 10 years, as far as it's so wide, trying to find homes. We're not competitive in the world market on soybean meal exports because Argentina continues to offer meal into the world $9 to $11 a ton cheaper on a regular basis. So we have to find domestic usage to use that meal. But this number should be okay right now. We don't anticipate changes in December. We'll have to wait and see on January. Now on soybean exports, different story than on corn. Remember we had a big drop from year to year? Well, the USDA's number last year for soybean exports, 2.17, this year raised up to 2.25 in spite of the large crop in South America. And the thing that's a little bit troubling is right now, today, through the first 13 weeks, we're not on pace to make that number. In fact, there are some people that think that number should be lowered as early as the December report. And if that happens, you know, we stand the risk of this carryout currently projected at 425 to start creeping a little bit higher. Now, history tells us that for the last 18 out of the last 22 years, this number tends to get smaller by the time we get to the end of August. So the funds are believing that today, and that's one of the reasons they want to be long beans, but we'll have to wait and see. We have to keep in mind that from an export side, we are fighting a very large crop in Brazil and Argentina that they raised a year ago. And their exports are much higher this year than what they were in the past, so time will tell. December report, I think there's a good chance we don't see any changes in this, possibly in January. Come to the bottom line. When we look at comparing the carryouts from year to year, 301 million last year to 425, we also see that the soybean ending stock number is going up. Pretty fair amount. So possibly some more prices, but right now, today, they don't seem to care. The focus is on South America and possible weather problems down there. Last year's average price on beans, $9.47. This year the range is $8.45 to $10.15, or an average of $9.30. So just like in corn, according to the USDA numbers, ending stocks are going up, price projected to be a little bit lower. So with a $9.30 average price right now on this deal, if I'm looking at a marketing plan, $9.30 is where I want to start watching things closely. As we get closer to this upper end, I want to get more aggressive with my sales. And with the markets done the last few days here, we're not quite there, but in a weather market like we're in right now, it can happen quickly. So I think this is a time not to get too bullish on soybeans, but to watch closely for an opportunity that might be real close to us in the next few weeks here. These weather markets always turn out the way we think, right? What usually happens? We run them up, it's going to damage, crop's going to be zero, and then it rains, and oh my gosh, where did this crop come from? We've never done that, have we? Same thing happens or can happen in South America. Okay, let's go global a little bit here now. And this is part of the global snapshot I wanted to show you. INTL FC Stone put these maps together, so we want to give them credit, but I think it's a very nice perspective check and gives us an idea of where we're at and what we're competing against. Here's 2016 world corn production. Now the reason we go back to 2016 is we do not have the 2017 crop final information for the US yet. So we will update this later. But basically what this shows, and I don't think this year it's going to change a lot percentage-wise, the United States can be proud that we are the #1 corn producer of the world. We produce 36% of the world corn. 20% produced in China, 9% in Brazil. The Ukraine would be mixed into this former Soviet Union, and then we have Argentina at 4%. So between the two main corn producers, 56% of the corn's raised in the United States and China. But what do we know about the corn that's raised in China? It's going to be used there, right? They're not going to share it with the world. If they have a big crop, they're going to hoard it just in case they need it down the road. Now, they're kind of short-sighted because they get themselves into a situation like they're in right now where they've got too much corn, they can't use it fast enough, and it starts having some serious quality issues. But that's a program they're trying to address and fix right now. Some of these other areas, though, you know, that are pretty minor producers, Argentina, the Ukraine, and Brazil, even though they're not major producers, if they produce more than what they're going to use, they're going to export it. And that's why when we look at this slide, nope, one coming yet. This is on yields. Sorry about that. This is another perspective check. We looked at the genetics of corn, and we all realize they're not just available to the U.S., they're available to the world. Here's where the U.S. is at today. The last 4 crops have been well in the 170s, the last 2 crops 175 plus. But look at the average of the rest of the world in this blue line. The average for corn yields for the rest of the world is well under 100 bushel per acre. We can see China on here. We see China on this line here, Brazil here, European Union here. It doesn't really matter where you're in the world, what's happening to corn yields each and every year. They're going up. So even if we don't change acres, we're going to have more corn to work with. And a lot of that's genetics, and we've seen the same thing in wheat. And that's why we have an oversupply of starches in the world right now, or feed grains. Here's the chart I thought we were getting to. This looks at the share of export corn by the U.S. This is where we were in the year 2000. This is where we're at today. We continue to see our export share of exporting corn go down. Now, where is it going? Well, this silver line right here is Brazil. We go back to the year just 8-9 years ago, Brazil really didn't export any corn to speak of. And today they're very significant. If they raise more corn, they only use so much, they're going to export it, and they're going to export it at the price it takes to make it work. This little blue line on top is the Ukraine. Basically no corn exports 8 years ago, and now significant. In Argentina, in the copper colored here, you know, they're pretty consistent. They raise corn, they're going to export about the same amount. But Brazil and the Ukraine really is where we've seen this competition come in and take a lot of export business away from the U.S. That keeps the inventories backed up a little bit in our country and has these stocks at levels that keep prices low. Now here's an area that we possibly can get some support out of the corn market down the road. We're not talking tomorrow. This is maybe over the next 4 to 6 to 8 weeks. This looks at Brazilian corn production. In Brazil, they raise 2 corn crops. The blue bars are their first corn crop, and we can see for years, up until about, probably about 2000 or so, that was their predominant corn crop. The gold or yellow lines are their safrinha, or second corn crop. That corn crop is planted literally right behind the harvest of their beans. You've probably seen pictures where you see the bean combine going down the field and literally the corn planter right behind it. Well, this year we've seen a fair amount of the main soybean producing states in southern Brazil plant their beans a little bit later than normal because it was too dry, especially like in Mato Grosso, which is their #1 soybean producing state. Now, it's all been planted since then. The rains have come, and it looks like things are going to be okay. In fact, crop estimates for the bean crop are actually starting to go up a little bit. But the point being, if you plant your beans late and you're going to follow it with corn, your corn is also going to be planted what? Late. And in the area of Brazil, where this safrinha corn is raised, you stand the risk of getting into their drier season and possibly more heat that can affect pollination. So you can see here, it's a huge part of their corn crop right now, and if their corn crop is big, then we see a jump like this. You see very strong exports the following year. So we need to watch the weather as the Brazilian second crop is planted and as it goes through its growing season. If the safrinha crop is rated as being in trouble and getting smaller, that could give the market some confidence that exports will come back to the U.S. In fact, just this morning there was one private estimate out of Brazil. Last year's safrinha crop, I think, was around 83 million metric ton. This year's the estimate updated this morning was down to about 63. So if there's 20 million less corn raised in this crop, that could bring more business back to the U.S., get those exports going again, and hopefully drop that carryout down a little bit. It's going to take some time to develop, but it's something we need to watch. When we look at global corn, we see for the last 3 of the last 4 years, very high inventories, 80-day supply of corn left over for the world on August 31st. That's more than enough. But now we see from last year to this year that inventory for the world starting to drop. We have to keep in mind that about 60% of the world ending stocks of corn are held by China, and China doesn't share. So the only way world stocks can really go down is what we see here. This is China starting to liquidate some of their off-quality corn, paying their ethanol plants subsidies to use it up and get it out of the way, paying their farmers to raise soybeans versus corn to try and bring the production down so these ending stocks can come down. And if we take the two main corn producers out of this equation, the U.S. and China, then all of a sudden this world supply drops down to about a 45-day supply, which looks like it's more like average. So this is something I think maybe a real faint sign that these lower prices are finally starting to slow down production in the world a little bit or find enough demand to start ending up using some of these ending stocks up. What about soybeans? U.S. was #1 on corn, but when we look at soybean production, 33% of the world soybeans raised in the U.S., 32% in Brazil, 16% in Argentina. And this is why the market focuses on these two hemispheres. When you're growing beans in the southern hemisphere, right now, that's 48% of the world bean production. Next spring and summer, when we're raising soybeans up here, it's 33% of the world production. So over 80% of the world's soybeans are raised in those three countries. Oh, by the way, we had a gentleman up here from Brazil probably 6 months ago. His numbers and their estimates down there is within 1 to 2 years at most, Brazil will be the #1 soybean producing country in the world. Last year they had a record crop of 114 million metric ton. We said, well, what do you think, what can you raise down, what's the potential? He said within 5 years we expect to be consistently raising 125 to 130 million metric ton of soybeans. So they're just getting started. And it's not all land expansion. A lot of it has to do with what we're talking about here, improved yields, improved management practices, better farming. Just got this. This is the first time we've used that at this meeting, but this has to do with world beans. And I think it's pretty interesting. Here's, if we look at the last 5 or 6 years here on total soybean production in the world, look at what that's done. From 268 million metric ton up to projected now at 348. It's all about protein. It's about feeding this tremendous demand into China. And look at how the U.S. compares in this picture. Out of the 348, we're 120, and ours is going up some, but look at the changes in the South American side. Look at Brazil, 5 years ago at 82, then to 114, this year projected at 108. And Argentina is pretty consistent, but you can see how those three main players fall into place. And it's all about having more protein, because what we're trying to do is we're trying to meet the demand of this Chinese economy. When we look at the top soybean exporters of the world, remember the U.S. produces 33%, Brazil 32%, but on the export side, Brazil is in charge right now or taking care of about 43% of the export business of the world. The U.S. is at 41%. So they already are the #1 exporter of soybeans in the world. And you have billions and billions of dollars being injected into this Brazilian infrastructure to build export terminals, railroads, highways, to get these beans into position, because they also see the growth coming down the road.
Did you see that Cargill, ADM, and a couple of other competitors are joining to build roads in Brazil?
Yep. China's also given billions of dollars to build railroads. In this one, we've talked about it before, a previous meeting, there's a highway that goes from Mato Grosso all the way up to, I think it's, I'm not sure which of the export points, but it's BR 163. And there's about a 26-mile stretch that isn't finished. It's still literally just clay. And when it rains, it turns to mush. And that's where you see the pictures of the stuck trucks and stuff. And somebody's trying to get the Brazilian government to accept money for them to come in and finish that section of road, because right now it's a tremendous delay and bottleneck during harvest. So a lot of things going on. The world demand is growing, but we have to be aware. We're not the kingpins anymore, are we? We're one of the players. And when we look at where all of these beans that are exported go, 64% are going to China. How would you like to put a business plan together like that and go to your banker? Say, I want money to build this business, but oh, by the way, and he'd say, well, who's your customers? Well, one customer, it takes 64% of my product. And what's he probably going to tell you? Go check at the bank down the road, right? This is probably a reason why President Trump stopped over and patted Premier of China on the back, because pretty important to American agriculture, and we'll look at that in a second here. As far as total demand out of China, we see domestic consumption of soybeans and soybean meal continues to go up drastically. Projected right now at somewhere between 113, 114 million metric ton for the upcoming year. And they import around 96 to 97, so the difference is what is the soybeans that the Chinese farmer raises, about 14 million metric ton. Just look at how this demand has changed. Just in the year 2000, probably about 16 million metric ton. Now this year projected it could well be over 100. Unbelievable growth. And then we come to this slide that shows out of the U.S., here's where the exported beans that we ship go. The blue bars are to all the other countries of the world, and this is China. We better hope, and this is why I think even President Trump is a little bit careful dealing with China. We need them, but with the kind of demand that they have, they also need who? They need us, right? Because they cannot get all their beans out of South America today because it's just not logistically possible. We talked a little bit earlier about crushing beans in this country, and really the focus right now is probably on soybean oil and biodiesel, and we end up with a lot of meal, so I threw a few slides in on livestock production. You know, around this part of the world, we see more hog barns being built, and it just seems like we are in hog country, right? But when we look at where the domestic usage of soybean meal in this country is, the hog industry only uses about 22%. Poultry, 55%. Now, we don't see that around here, but that's the big user. And it goes into this protein thing again. You know, you can turn poultry barns so much quicker, make a lot more meat out of that same acre, and this is what the world is eating now, more and more poultry. From a world standpoint, This fits in with the Chinese demand. The U.S. has 13% of the world pork production today. China has 68. Can we even imagine that? I mean, you drive around our country and you look at how many pigs. Lyndon, what are we killing now a day for hogs?
Killing a day? 425 to 50,000.
Yeah. 450. In fact, I've heard some weeks as high as 465,000 head of pigs a day in this country. And look at what that would mean in China. We're only 13%. And here's the thing when you talk about demand out of China. They have 68% of the world hog production, and what do they also do? They import. They're the number 1 or 2 importer of pork out of the U.S. And we export right now over 30% of the pork that we raise, we're exporting mainly to Mexico and China. Unbelievable. So the growth, where does it stop? Oops. Poultry production was the other one that I had here. Sorry. United States produces about 27% of the world poultry, 18% in China, 19% out of Brazil. So, that's a big demand source, once again, for meal and for feed grains as we go forward here. When we look at the world soybean meal carryout picture, what we see here is the demand in the blue bars, and the usage and demand just continues to go up at phenomenal rates. It's all about protein. It's about taking that protein and making meat to feed the masses. And right now it just doesn't seem like it's going to stop. A person asked after the meeting in Windham this morning, what about India? You didn't talk about India. India is the up and coming China. I've seen estimates where within 2 to 3 years, India will have a greater population than China. And the Indian population today is not the old traditional Hindus that do not believe in eating meat. Kind of like in this country, our young people don't always follow the traditions, right? And all of a sudden meat is becoming more accepted, and the demand growth there is phenomenal coming down the road. So we see stocks to use ratio for meal in the world going down, which is supportive to prices, and we look at ending stocks for meal, it's flat because this demand is just so great. We're just barely keeping up with production. Okay, now to weather. Here's a slide on La Nina.
Hey, Dan?
Yes.
I've got one other question about the China thing.
Yeah.
Given the fact that Brazil thinks they're going to be the #1 producer here in a few years.
Yep.
And yet, the next couple slides, we said China meets the U.S.
Yep.
Is this not as bad as we think? Because we got the 2 suppliers are opposite seasons, so instead of dealing with 1 supplier for the whole year, they get 2 guys for half the year. So China may keep us in the picture instead of trying to go all to Brazil when they have extra production.
Yeah, and I don't mean to paint a real negative picture. I think we just need to be aware of it. First of all, China will not try and break it as, all right, now this time of the year we buy from Brazil, this time of the year we buy from the U.S., because with the quantity of beans that they're taking in, this year projected to be around 100 to 101 million metric ton, they have to have ships of beans coming in every day from both sides. Because today, they cannot rely on logistics out of Brazil. If they buy beans out of the U.S., what do they know? They're going to get loaded on time and delivered on time unless something unforeseen happens. They can buy beans out of Brazil and Argentina, and they might get them on time and they might not. But with the quantity that they're bringing into their ports, it has to be like clockwork. So even when Brazil becomes the #1 producer and a larger exporter, they will still be buying beans from the U.S. so that their logistics all work. Now, what will happen as Brazil grows more and more beans, there'll come a point where they can only export so many in October, in November, in December, and if they have more beans, see their shipping season extends. And that's where the challenge comes for us. And honestly, I think we've seen that to some degree this year, because early on at harvest, anybody remember what the bean basis was around here? 85, 90, 95 under. Was that good?
No.
That's pretty bad. What happened? Large crop, that 114 million metric ton crop out of Brazil, they normally ran out of beans by the end of August or September. And this year they were still selling in September and even some into early October, which was taking business away from who? Us. So that we didn't have a decent rail market to go to the exporters, because the exporters couldn't sell beans because they were still coming out of South America. Now eventually that changed and basis started approving, but it was 30 or 40 days later, and it made for quite a hassle during harvest, right? So that's what I see happening. And in fact, I seen something, I think China was behind it also, where it was a huge amount of money that they were talking about building storage in Brazil. I mean, they have I think they've got like 26 export terminals now on the river and on the coast. So there's plenty of export capacity. The challenge is getting it to the export, transportation, but also being able to hold the crop when they want to harvest it. So China's looking at it now saying, you know, we can put bins up in Brazil and fill them, and then we can pull out of those bins all year long. We don't have to try and ship into that tight window, and that's what will happen with the bigger crop down there. Make sense? Any other questions? Yes?
Cost of production in Brazil compared to us.
It doesn't matter.
But it's got to matter, because you're not going to.
We asked that question of the gentleman from Brazil. The day that he was up here speaking with us, the price of corn that the farmer was receiving in Mato Grosso was $1.81 a bushel. True story. And keep in mind, this is in Mato Grosso, and to the one export terminal, it was 1,100 miles. And we said that too. Well, they can't afford to raise corn. And he just laughed. He said, no, you guys, you're thinking like Americans now. And we said, well, what do you mean by that? He said, well, you raise one crop a year. And you split your acres into corn and beans, one crop. He said, that's not the way it works in Brazil. It's continuous crop. We harvest our beans. What do we do behind the combine? We plant corn, we plant cotton, we plant rice, we plant wheat. And when we take that off, we plant something else. He said the average farm in Brazil, not quite 3 crops a year, but 2.7, 2.8. So he said it's all about revenue, see? It's not about cost of production, it's about dollars off of that acre. And would that change? I mean, that's hard for us to grasp, right? But would that change your mindset here if your cash flow was 3 crops rather than one? That was his answer, and I guess I can't argue with it.
There's probably more difference in the cost of production per bushel in this room than there is between here and Brazil.
That's very, very possible. Very possible. Yep. They're not going to, he said the one thing they won't do is let land lay idle because it costs more to raise it than not, because they need revenue coming off of that acre or hectare.
What about weed pressure compared to us?
You know, their bigger challenge, I think, or the one that the focus is in Brazil, is soybean rust. I mean, we talk about cost production on corn. How would you like to do this? He said the average farmer in Brazil sprays their crop for soybean rust on the average 6 times. And there's literally laws in Brazil that prevent, you cannot plant beans on beans in Brazil as a way to try and prevent this soybean rust from spreading and getting to be more of an issue. That's something we don't even talk about. We complain we have to spray for aphids once, right? How would you like to have to spray for rust 6 times?
They've got the
Different
same
way.
access to the same herbicides and insecticides
Yep.
that we do.
Yep. The climate is different. You know, the soil is a little bit different, but yeah. Good questions. I hope I'm at least not leading you astray, but you know, INTL FC Stone once again, you know, you see a fair amount of slides from there. They have at least 2 or 3 brokerage offices in Brazil now, and they have a lot of employees, and they're more than willing to share information, and we've been on conference calls. They'll come up and visit us. They've invited us to come down and visit them. And that sounds really great, but you know, it's a new frontier down there, and you got to be really careful. Yeah, we've talked about it, haven't done it yet. Maybe someday. Before Jim and I retire, we're going to do that, okay? Go see Brazil.
Oh, okay.
Yeah.
I'm game.
Okay, back to weather here. Here's La Nina. This is what a La Nina is. Here's our equator right here, the EQ. Here's South America. So a La Nina is below normal sea surface temperatures along the equator off of the coast of South America. You'll see some reports just call them SSTs. Now, what the experts say is to really be a true La Nina, we need to see it about a minus 0.1. So you can see these colors, minus 0.5 to 0.1, and you can kind of see this is where we were at about roughly a week ago. So we're pretty much we're on the doorsteps or kind of going into a La Nina. Still fairly minor. The Australian Weather Bureau is kind of the bell ringer on this thing. They watch it, and 10 days ago they came out with their updated forecast saying they believe there's a 70% or more, higher chance that we will have a La Nina in late 2017 into 2018. A couple of questions. How strong is it going to be? How long is it going to last? We don't know that. This is one of these weather things. Now, one thing that we do know is since 1950, we've had about 6 La Ninas that occurred during the same time when the solar activity was on the low side. And the sun is projected to be a little bit on the lazy side in 2018. So it kind of fits in, slow sun, La Nina. But 5 of those 6 times, the La Nina was pretty well established by the 1st of October. And this year now it's quite a bit later than that, so they don't know just how it's going to play out. Now, some have thought that this thing maybe doesn't get real strong, but it lasts through the entire year of 2018. And if we see this La Nina stay established into spring and summer of 2018, then you're going to hear some talk that it could affect the yields in the U.S. And when we look at the map on what this might mean, you can kind of see some of it might be developing now, but we just don't know how long it's going to last. So the areas of concern right now, the main areas that risk during a La Nina typically are Argentina and southern Brazil. So we look here at the 30-day forecast for South America. This is from World Weather. You have temperatures on the left, precip on the right, and here's the 90-day forecast for what it's worth. We know that that's hard to peg, but basically this would be for their entire growing season down there. Remember now they've pretty well planted the crop. They'll start harvesting late February, early March. What we're looking for is much below on the precip side, and we can see once again parts of Argentina and extreme southern Brazil for December. And we kind of see that stay around for the balance of the 3-month period. But you also see the majority of Brazil getting plenty of rain. Crop's been planted. Crop's doing well. In fact, now a lot of the private estimates coming out on the potential for the Brazilian crop are actually going up. And you remember way back a few slides ago, Brazilian crop projected at 108 million metric ton for this year. Argentina crop about 56, 57. So which is more important? Brazil, really. So what I'm telling you is a little bit of caution. The rally in soybeans the last few days is off of weather concerns of Argentina. Not that it's not significant, but a bad crop in Argentina doesn't always mean a bad crop in Brazil. And they're the bigger one to watch probably right now. Here's the U.S. This looks at December through March. Temperatures on top, precip on the bottom. This basically is the time frame we're just entering, and this is the forecast from World Weather, what a La Nina may mean to the U.S. Now, we laughed at this forecast in late November because it was all above normal, and now what do we hear in the forecast for the next couple of weeks? Below normal temps, and maybe a chance of a little bit of moisture, but not much. Has anybody paid any attention how dry it's gotten the last few months here? Went to the cities over the weekend to a baptism, and honestly, it's been years since I seen the Minnesota River that low. Not froze over yet, but gosh, it's down. Des Moines River, all of these things for the most part, it hasn't rained much. And basically what this is saying is if we're in a La Nina, we could be cool and dry. So what might that mean if this verifies through March and we come into April and we're on the dry side? People might get a little bit nervous. Look at this area of precipitation. And if you pull out or go online and Google the drought monitor map, you'll see a lot of the areas in the wheat country and in the southwest where it's starting to show signs of drought again. That's pretty typical of a La Nina. Now the one thing that's a little bit misleading this year is it looks like it's not real dry in California. They've had better than expected rains in some areas, and that shouldn't happen in a La Nina. So it's not 100%, but it kind of looks like things might be going that direction. Okay, let's talk about the commodity funds before we get into prices here. This chart looks at the commodity fund position on corn. And we're going to take the last 5 or 6 most recent years. Here's a zero line. This would be as if the commodity funds or managed money crowd are even the corn market, neither long nor short. If they're up here, where we see a lot of activity, they're long corn. They tend to like to be long commodities. But where are they this year? Here's the black line. Commodity funds are short. In fact, up until about a week ago, it was an all-time record short. Now, if the funds are short corn, and we're coming up to December 31st, what happens on December 31st? End of what? End of the fiscal year, also end of the quarter. If you're short corn and been riding a short on corn from, say, last summer, markets went down, the only way you can show a return to your investors is by doing what? Buying it back. If you sell corn up here, goes down 50 cents and comes back up, how much did you make? Nothing. Only way you can lock in that profit is to buy that short back. And right now, there doesn't seem to be a lot of risk. The fundamentals on corn are still very what? They're bearish. There's no reason for corn to go up. But that's happened before, folks. A year ago, the funds were short corn. They came in and they covered about 100,000 contract short position. Corn rallied 20 cents. Now, we're going to see in a minute here, they've actually covered 100,000 of their corn short over the last week to 10 days, and corn struggled to rally 8 to 9 cents. And I think that's kind of just reinforces the idea that the fundamentals are pretty bearish right now on corn. It's going to have to work hard to get rallies. Here's where the trade believes the funds were yesterday, still short about 162,000 contracts. Corn was down a fair amount yesterday. They added to that short. But the day before that, they were down to having the short to be about 154. So they had covered almost 100,000 contracts of their short position over the last 3 weeks. There's still slight longs in the beans, and I'm guessing today they bought beans again. Yesterday, I think it was 4,000 to 5,000 contracts. That I'm guessing it'll be at least that again today. And you can see I put wheat on here just because they're also very short wheat. And we keep hearing the same thing. They want to be long beans for the protein, too much starch and feed grains, and they want to be short corn and wheat. So what do I do with my grain? When should I sell my grain? This is not a smart aleck answer. The market will tell you. The market will give you signals. And we need to just kind of keep reminding ourselves of that. Our goal is to sell when the future prices are high and to watch for an opportunity when that basis is narrow or low. But really, to make that all work together, we have to have a marketing plan. And we have to be willing to adjust that. We have to be willing to look at new types of contracts to try and make that as profitable as what we can. And before we get into the price charts, we're going to look at crude oil. Because we see that the crude oil market way back in June was $42 a barrel. Last week we traded as high as $59. The fundamentals on crude oil, were they negative here? We had way too much oil, right? Fracking industry started shutting down because oil got too cheap. OPEC said, we're going to restrict production, we want the price to go up, and the price started going up. But there was still too much oil around. There's still too much oil around at $59 a barrel. So the fundamentals are still negative. What caused this to go up? The flow of money. Never bet against the oil companies, right? Just kills me every morning. I listen to WCCO on the way to work, and they say, well, gas prices a year ago were $1.95. Today they're $2.50. Nothing's changed. Keep this chart formation in mind. Crude oil, in the eyes of the managed money crowd or the commodity funds, crude oil is the barometer for commodities. If crude oil is going up, they feel like they need to be a part of some commodities. Now, right now, they don't want to play in wheat or corn, but you'll see that this formation looks awfully similar to the bean chart over the last few months. I went back and looked at prices as far as what the range of prices have been to kind of see once, are we high, low, medium? You know, what can we share with the producers to try and help them here? And really on corn, if we look at the last 47 weeks of corn, we see the average kind of been around between 340 and 370 in Chicago. Where are we at today? We'll look at that in a minute. On beans, it's been about 940 to around 990 to $10. So where are we at today? Here's nearby corn as of this morning. A couple of things to point out. First of all, we know we all wish that we had sold stuff up here, right? But when we look at the last few months, we see September high 358, October 355, November 349, so far 346 and change in December. Lower highs. What about the lows? 342 in October, 346 in September, 342 in October, 336 in November, 335 the end of November. What kind of trend is the corn market still in? Down. Lower lows and lower highs. I don't like it either, and I know the American farmer doesn't like it. The one thing I will tell you though, you know, RSIs is about 45. That's one of the things we listen to the market. And at 45, it's just kind of neutral, not overbought, not oversold. But the other thing you can see here, the corn market typically doesn't make bottoms like this, what we'd call a V bottom. A lot of times, you know, we get these big stocks of corn, and the corn market will do what they call a saucer bottom or a rounded bottom, because it takes a long time. It takes a lot of patience to work through those extra bushels. And if you can use your imagination a little bit, maybe we're finding that demand base down here where we get down to a certain level and we just find more buyers and sellers, and the market turns around. Here was the crop report day in November where we found that 3.6 bushel increase. You know, we went from 349 almost down to 340, down almost a dime that day. And at that point in time, people were saying it's so bearish, the price of corn is going to zero. Has that ever happened? No, because we find demand. Maybe we're finding it here on corn. And when we look at those average prices, remember that average price range for the last year, about 340 to 370? And what this looks at, it's a real busy chart, but this goes and looks at the last 6 times that we had big carryouts in corn. 2 billion bushel or above. And believe it or not, the averages of those years from January to February, the price in Chicago average, the low was around 343, the high was just under 380. And today we're right around probably that 355 area for March corn. So we're in the lower end. And I would tell you today, I wouldn't make corn sales today. That doesn't mean I don't watch things closely and start getting my marketing plan in place, because if and when something happens, I want to be ready to sell because these fundamentals on corn are still pretty negative. What about soybeans? Remember that crude oil chart? Does that look familiar? Tracks real close, doesn't it? Now, we have to be a little bit careful because crude oil the last few days has kind of been working its way lower. I don't know how we closed today, but since last Friday, we have been kind of coming down a little bit. When OPEC had their meeting last week to discuss extending their production cuts all the way through 2018, Mr. Putin from Russia made a point that's saying, if we do that, you have to be very careful because at $58, $59 crude, what is the fracking industry in the United States doing today? We're drilling wells like there's no tomorrow. Just watch your railroad track here on the Union Pacific. These trains with the short cars, 2 hoppers, you know what they are? That's sand. That's going to the frackers and their shuttles, and they were parked, and they were, when crude was at $40 a barrel, they were parked and in storage. And now you're seeing those trains go all the time. We're building more, and what Putin told OPEC, if we curtail production, prices may stay where they're at or go higher, but we're helping the U.S. frackers, and now the U.S. can export crude oil, and they're going to take our customers away from us. And we will. So we have to be a little bit careful. Crude has given, some hope to the bean market. We've been going higher. Yesterday we had a high at 10.08. Today I think we were up in the 10.20s for nearby beans. Carry in the market. Remember what the average price of soybean futures were over the last 47 weeks? About $9.40 to $10. You see, we're getting up into that area. I think we need to be watching this bean thing very closely. This morning, before the rally, RSI, the Relative Strength Index, was up to about 63. Now, if that starts getting above 70, the market is what? Overbought. Due for a correction down, because more people have been buying than selling. So that's where you need to listen to the market. If we're making new highs, that's not the time to get bullish. Our highs way back into last summer are up in this 10.22 to 10.27 area. We're almost there. Can the market go higher? Sure it can if this weather thing stays around, but we all know how fickle weather markets can be. As the RSI gets into the 70s, be very careful. Here's March soybeans. We look at 2016, 2017, 2018 here in the red. And we can see now, especially if we put another dime on today, we're getting up into areas where we're pretty high priced. But remember, if those ending stock projections are right, we actually have more beans left over than a year ago. And theoretically, we probably are a little bit overvalued right now. But it's off of this fear of La Nina and concerns in South America. From a seasonal standpoint, we have on the left here corn, beans on the right. This looks at the current price action in the green, the 3-year in the blue, and the 5-year in the black. A couple of things to point out. As we come out of harvest, we tend to have a little bit of a break in corn. A lot of times we have a little bit of a bump as we get ready for acres and for the spring reports. Then, of course, we have ups and downs. When we say sell the rallies, that's what we're trying to do here. And that, once again, listen to the market. Your RSIs and stochastics will give you hints there. We see the same type of thing on beans. The other thing to point out, when we look at the calendar down at the bottom, both in the 5-year and the 3-year, if you hold old crop grain past the 4th of July, what should you expect for prices? It's over. So basically what it's telling us, corn and beans both, we've got about 7 months in this window now. It was 12, but now it's down to about 7. December through June, we want to have our marketing plan pretty well executed. So what should I do? I think today you watch for basis improvements, especially on corn. Now, when I put this down, this was kind of before the bean market started to rally. And I think now the bean market is catching up enough steam. Just listening to the phone calls the gals are taking today, there's a fair amount of beans being sold. So I don't know that the processors and the exporters are going to have to push real hard for beans because the market's doing the work for them. But on corn, how many guys want to sell corn today at today's prices? Come on, guys. Remember, we use over 1 billion bushel a month. We have to get some corn out of your hands. These ethanol plants are going to run out. So if the price doesn't stimulate it, then either spreads or basis maybe has to do some work, right? And keep in mind, you don't have to do that at the same time. If you get a good basis opportunity, you can lock that in and then wait to price it when the funds come in short and the market rallies. Because if the market rallies, how many guys in the United States want to sell a want to sell a 20-cent rally on corn if given the opportunity today? Yeah, I think you're not being quite honest with yourself, because somebody else I know did a survey and they came back almost 75%. Not that they're going to sell all the corn, but the farmers would make sales if corn rallied 20 cents. Time will tell. Okay, watch for commodity fund short covering in corn, because that can maybe give us a little bit of a bounce. The disappointing thing, like I said earlier, they covered 100,000 contracts over about a 7 to 10 day period, and the corn market rallied 8 to 9 cents. But that's better than nothing, right? Our average prices for the year in the ranges, 280 to 360 on corn, 320 for the average. Once again, first target is to beat that average price, and as we get closer to the upper end, if and when we get that opportunity, be more aggressive. Soybeans, 845 to 1015, an average of 930. Watch closely here. Look for places to sell above that, and as we get closer to $10, become more aggressive. If we get the opportunity at some point to sell beans close to $10, which we did a year ago, after harvest, I think they got up in the mid 990s. That's not the time to get bullish, right? And don't call Jim up and say, Jim, what do you really think I should do? You know, have a marketing plan, stay disciplined, and execute it if you get the opportunities. We're going to talk here in a minute. If you have on-farm grain in storage, both corn and soybeans, there's carries in the market. The market is telling you to sell the carries today. Watch for La Nina effects on weather patterns, both in the U.S. but especially in South America. And right now, today, the focus is mainly by the funds and a lot of people on Argentina. If all of a sudden this weather forecast changes, even the noon updates today say, yes, it looks like this hot and dry condition in Argentina is going to stay around for the next 10 days. Anybody heard that line before? It can change overnight, right? Respect and reward market rallies. And don't get too bullish at the wrong time. When the market's making new highs, RSIs are inflated up in the 70s, 80s. Yeah, they can stay there, but eventually that market's going to correct. What's that now? I'm a realist. I gotta tell you this, because I put my reputation on the line here a couple of weeks ago. Every Monday morning, Matt Widboom and I have a little market update on KO95. And the Monday before Thanksgiving, and I get a lot of ribbon from employees here in the office because they say I'm just a fair weather fan. I said, no, I'm a realist. I grew up in the 70s. I seen us lose 4 Super Bowls. I was at the game when Pete Anderson shanked that kick against Atlanta. Anyway, before Thanksgiving, talking to Matt that morning, we were talking about Thanksgiving, and I said, I predict a Vikings victory. And 2 of the employees here just about went in the ditch. And then I added that I was a realistic Vikings fan, and that means that you don't get too confident yet. So every week to me is a tough game for the Vikings. I think this coming week is going to be a real telling sign. Playing Carolina in Carolina after Carolina kind of got cleaned up on this last game, it's going to be a tough game. And did anybody watch the game last night? We thought Cincinnati was a patsy. Did they beat Pittsburgh? Pittsburgh came back? Oh, God. When I went to bed, they were still down 10 points. Yeah. Well, anyway, okay. So maybe Cincinnati is not there. But anyway, we'll see. A lot of this stuff you can get out of our presentation is based on history. And history says what about Super Bowl teams? 51 years so far. This is 52 coming up, Super Bowl 52. 51 years. And the host city has never had a team in the Super Bowl. That's pretty reliable history. And then I think back of a close personal friend, Sid Hartman, who should retire. And what is Sid's famous line? It's all about M-O-N-E-Y, baby. If we have Minnesota in the Super Bowl this year, does that make a bigger revenue source for the NFL or less? You want people coming from all over the world, right? I'm sorry. I think it's all fixed. Now you know how I really feel. Okay, let's talk about markets. Sorry to get distracted there. In the markets, there's really three types of markets. Remember, when do I sell my grain? We want to listen to what the market's telling us. First, there's a flat market. We have that in soybeans for Dec and Jan, where the price is the same. The market doesn't care if you sell your beans in a flat market. In December, January, you're going to get the same. It's convenience for you. Second type of market is an inverted market. This is an inverted market where beans in July are worth $9.55, August $9.52, September $9.32. An inverted market is telling you, you better sell your beans by July, because if you don't, we're going to take money out of your pocket by giving you a lower price. And then the third type of market is a carrying charge market. And that's what we have in corn, where each month in the future is a higher price. Now remember, I said the market's telling you, if you have on-farm grain, to sell the carries. 301 for spot corn, let's just call 330 for August SEP. A carry of 29 cents a bushel. Now, don't assume that when we get to August and September, corn is going to still be worth this type of premium, because the market is offering you this carry to hold it off of the market, because right now it's got 16 to 17 billion bushel of corn available, and it knows it can't buy it all then. It doesn't want to. So it's holding a carrot out here saying, you sell your corn for August or September and we'll pay you today. But theoretically, if nothing changes between now and next August, when we get to August, what will the price of corn be? 301. 301, because that's what the market believes is the fair value of spot corn today. So the only way to lock in this carry and pay yourself storage is to sell that carry. Actually, if you wanted to do the old rotation game, remember back in the government storage days where you could rotate those stocks at harvest? Market's paying you a 35-cent carry out to new crop. So sell new crop grain and deliver your old crop and new crop, or deliver your new crop out of the field and leave your old crop in the bin. That, I know that logistically that doesn't work, but you know, if a person has extra space, that's what the market's telling you to do. What about beans? $9.27 on nearby, $9.55 in July, a carry at 28 cents. The difference is it costs you more interest to store beans, or carry beans, right? So it can work if it's on the farm, but it doesn't work as well. Like we've talked about at some of our previous meetings, if you take this to a banker and show them this type of carry, this is what I want to do, John. I want to lock in. I'm going to go out and sell August, September corn and pick up 30 cents. Will you borrow the money? You will not find a banker that'll say no, as long as you do it, right? Don't go to the banker and show him this and then go back in 3 months and he said, boy, you got to be feeling good. You locked in that 30-cent carry. Life is good. And you say, well, I thought about it, but I didn't do it. Then it's not so much fun, right? That 30-cent carry, I realize there's some interest to go against it, but 30 cents on 200 bushel corn is what per acre?
15 bucks.
$60, right? That's serious money, right? That can be the difference of making it or not. If you've got the bin there anyway, that's what the market's telling you to do. Questions? Okay, wrapping up my share of the program now. You know, our country does a great job of having a national holiday, Thanksgiving Day, where we're all supposed to take a day off from work and be thankful for the blessings that we have. And a friend of mine sent this to me the day after Thanksgiving, and it kind of stuck in my head, and I wanted to share it with you. You know, wishing you a Thanksgiving Day blessings all year long. It's good that we're thankful one day out of the year, but what about every other day? And what about every other hour and minute? We are truly blessed in this country, aren't we? The good Lord reigns upon us, I mean, every day, every minute of every hour. So as we get to Christmas, I want to leave you with this. You know, when we look at the word Christmas, far too much of the world sees what? A big commercial holiday. Meals and gifts and Cyber Monday and Black Friday. But the heart of Christmas is all about Christ coming to earth, right? Greatest gift of all. We didn't have to do anything for it. We didn't have to shop for it. This is a gift from the good Lord. Now, the challenge is, we live in a Christian nation, last time I checked. And our challenge is, there's a lot of people in the world that what? Don't know this. And we are left here with the responsibility of sharing it so that others are able to share in this gift, right? I know it's not easy, but this is really what life is all about. I like to put a little something like this in at each presentation because we can't focus on the markets and because that can be depressing. There's more to life than the markets, right? Okay, Jim, let me give you let's see, what do we got to do here now? He tells me.
Does the red light mean it's off then? Is
No,
that
it's
what-
on. No, it's
Okay.
on.
Okay, what I want to visit about this morning, or this afternoon, I should say, is we have some specialty contracts and a managed marketing program that I want to present to you. The first thing that I want to mention is that these type of contracts do have a cost. And with single offer contracts, if you're looking at something on new crop of 18, it's 6 cents a bushel on corn, 12 on soybeans at this time. Beyond a year, and that's a half a cent per bushel per month on the first 12 months on corn and 1 cent on beans per month of time. Beyond that, it's a quarter of a cent on corn and a half cent on beans on anything additional beyond 12-month time period. The combined program that I'm going to show you, you don't double the cost of doing these contracts. On corn, we take whatever the furthest month out is and add 2 cents to it for the second offer. And on soybeans, we take the furthest out month and add 4 cents per bushel. So a combined contract will cost you less than a single offer. What I also wanted to mention is that from Matt Campbell from FC Stone put this together. This is the predicted price range on corn on the July futures of 18, a 340 or a little bit below that low, and a high at about 410. That's the expected price range for current conditions. And on December of 18 corn, again, a little bit below 340 to a high of 440. So that's kind of your price range that they expect at this time. And then on soybeans, the other thing I'll mention on corn, they're using 340 a lot. So when you're talking about this cash price that Dan was mentioning before, about the $3 cash price for nearby, that's part of the reason why that 340 is always constant. On beans, price range expectation of about probably $9.40 on the bottom end. Top end is $11 futures. New crop of 18 has a range of probably about $8.90 to the top end of $11. So the price range on there is greater, but also you'll notice that if things turn out the way they might, we're looking at lower lows or the possibility of higher highs. So soybeans have always a history of a larger amount of volatility in the price. Now what I want to look at here is this is what we call our conditional offer contract program. And we're combining two offers in this program, one against July of 18 futures at 390 and December at 420. By doing so, after the cost of administration, you're going to end up with a cash price at 347 for July delivery, or 21 cents above the market. So if we can get that 20-cent rally that we're hoping to see, that then would become 367. Your offer is about 18.5 cents higher than where the market is currently on the July futures, and 33 cents higher on the December futures. The other thing that on these type of offers that we have to keep in mind is there is only one pricing date for each of the offers that is important: June 22nd on the July offer, November 23rd on the December offer. If the market is below your offer value on those dates, the offer goes away and you're not committed for any additional bushels. If the market is at that price or greater on that date, then you're obligated for delivery of those bushels. And on a chart on corn, this is the July of 18. With the 390 offer, that arrow point is where the offer value would be at. This is where the market was at on November 30th. On December corn, the 420 offer is here. This is where the market was at on November 30th. You also see that on this corn, there's been very few days on the December of 18 that is even traded above 420 at this time. Another one you could look at is on soybeans. Again, this is now for June of 18 delivery. A July offer at 1080, a November offer at 1060. And on that program, works the same way as you have those pricing dates. But your final result then, instead of the 942 cash price, you're receiving 987. Here you gain 45 cents on your initial sale. July futures would have to go up 63 cents. November of 18 would need to go up 59 cents before those offers would be executed. And again, the pricing dates are important here. I didn't mention this before, but producers that have open stored grain, DPA grain, can participate in this program when you're actually making your sale of your grain. You can't forward contract those bushels out for the summer months, but this premium of 45 cents can be added to a sale of your stored grain for whatever our spot price is. So you can do it that way. Another way would do it is that if you're really bullish the market and you did a basis contract, and let's say your basis was 40, or let's say 60 under the current month, that all of a sudden became 20 under. And you're still long the price for a higher value. And a third option would be the hedge to rise sale. If you're selling a board price, let's say at 1080, and you think the basis is going to narrow at a later date, you can add that 45 cents to that 1080 board price and have 1120 as your futures value. So there are umpteen different price levels. There are umpteen different ways to use this contract. And for the offer side of it on the soybeans, the offer is at the 1080 level on the July of 18. Here's the history of the July of 18. The market for July of 18 has never gotten up to 1060 at this time. And on the soybeans for November, the 1060 price is here. Again, you can't find any date that has been that high yet at this point. The way I look at these contracts, especially when you're talking a November bean or a December corn, this is a start of your marketing plan of your 18 crop. So in other words, if these futures values that are on the offers are at levels that under a normal basis is profitable for you, consider doing a portion of your crop. Now the maximum that we would ever recommend that anybody use on this is probably 25% of your crop production for a given crop year. We don't want to have you do anything like saying I got 80% of my bushels tied up in offers. You don't want to do that type of marketing. 25% is plenty. You don't have to do it all at one time. You can do it over 3 or 4 different or 5 different marketing time periods based on your initial price on where you think you want to market corn or beans. My personal preference is to look at using the conditional offer contracts when you're otherwise willing to make a sale of the grain. Don't do it so quick to have it become a rescue mission. So in other words, if corn nearby gets to 320 as an example, you want to reward the market with some bushels at 320, and then you want to place your offers and get something more in the 340 or 350 range as far as your final price. So use it in that way. So I'm with Dan. I don't want to sell corn yet today either. But when the market gets to a higher level, gets to a point where you're ready to make a sale, then consider adding the offer to it. That's the way I would like to see you use the program. The brochure that you were just handed out is a program that we've offered now for a couple of years. And what we've done now is we've created a pool of different entities that are going to do the marketing. So the way this works is if you said, I want to just turn over 5,000 bushels of grain to somebody, do you just plain market it, and I'm willing to accept the end result? This is the program that you might want to look at. There is a cost also of doing this one of a dime on corn, 15 on beans. So we have FC Stone, John Stewart, Roach, and New Vision. On the back side of the sheet, there are starting price dates, ending price dates. There are 17 crop, 18 crop, 19 crop programs within those dates. And also, didn't mention it before, but December the 15th, which is only about 2 weeks away, is the sign-up deadline on these bushels if you want to have some in these programs. I want to talk a little bit about how these different entities have marketed their grain. In the case of FC Stone, they have what's called an aggressive program and an enhanced average is what they're calling it. On the aggressive program, they use anything they choose to use to try and enhance the price. It could be futures, options, all kinds of just crazy marketing things to try and improve price. And then on the enhanced average, the way they've written up their promotional material is when they deem the market to be low in value, they will sell very few bushels. But if the market begins to rally, it's like putting your foot on the accelerator. They're going to start to sell more bushels to get to the total that you have in the program. John Stewart and Associates is very similar to this one up here, which is aggressive, where they can use any marketing tool that they want. Roach is a little bit different. He uses buy signals, sell signals. So in other words, if there are conditions in his program that say you should be selling some bushels, that's what he's going to do. And again, hopefully end up with a better than normal price. In the case of the New Vision Managed Marketing Program, we spin this off to another party. It's not Keith, it's not John, it's not myself. It's nobody within the office that actually is making the decision to pull the trigger. It's another party that does that for us, and their tendency is to have price targets, and if those price targets are met, they're going to do just a future sale. Maybe a little bit of a simpler program as far as its approach. I do want to mention, or a question was asked, is how does this all turn out? How have the background or the history of these things been? One of the things that I'm going to say is that no matter how past performance has been, does not dictate what future results are going to be. Each one of these is going to wind up with a different ending price. Their pricing periods might be a little bit different, but they're still going to end up with a different price. And one of the things that I have seen, and I'm not trying to discourage soybeans in the program, last year I think most managed marketing programs, whether or not it was ours or if it was somebody else's, struggled on soybeans. I have no idea or reason for why that happened, but it seemed like that was kind of the consistent result. In the case of corn, I want to say a little bit better results, but at the same time, you got to think back on last year's markets where probably for a 6-month time period, the market stayed within a 20-cent range, kind of broke out to the upside in the May-June time period a year ago, but then kind of faltered back into that same pricing range in the last 2 or 3 months of the marketing year. So in a way, they can't pull a rabbit out of a hat that doesn't exist. But at the same time, I think one of the benefits of doing managed marketing program is that on those bushels, you get to that final pricing date, those bushels are priced for the better or for the worse. So I think you may want to consider putting a small percentage of your crop in this type of program. I would suggest not more than 15%, maybe more in the area of 10% if you have some interest in doing it. Again, there's about a 2-week time period between now and December 15th to assign your bushels to one of these programs, or if you want to mix and match it, it can be done. With that, I do want to say I appreciate very much for taking time out this afternoon for the meeting. I want to thank Dan for his presentation on it. And if you have any questions on any of this as far as the conditional offer program or the managed marketing program, give John or I or Nathaniel a call here in the office, and we'll try and step you through it and answer any of the questions that you might have. On the managed marketing program, one last thing is that the earlier programs we did, we sent out hard copy reports. Our intent is to get that to our website. For those that are participating in the program, they will be able to see the reports, they will see the analysis on why they're doing certain things, and those that are participating in a given group are the only ones that will have access to that information. With that, I want to say Merry Christmas, Happy New Year. Give us a call if you got something that you want to talk about on the markets. And one very last thing. Beans today's close, is the high so far on the 17 crop year. So it's time to look very serious about maybe getting some of your soybeans priced.
What did it close, how many cents higher today?
I think it was 10, I believe. So 9.37 is our closing price for today. On an earlier meeting, there was a question as what was the average price of beans for the 16 crop. It was 9.10. And today we're 9.37. So it's time to probably let go of some soybeans and start to price into a rally.
I think you should buy beans today.
Yeah.
I'm gonna go sell some.
Thanks again for coming.